Now, to get to your question about certain custodians, there's traditional custodians, those ones that only let you stay on that investment spectrum for traditional investments. So those are maybe the big brokerage houses that we know about and the big investment firms. So Merrill Lynch, Vanguard, Charles Schwab, Morgan Stanley, if you work with a financial advisor and such. And just remember, using your IRA dollars to make an investment into real estate is actually not that different than probably buying that same real estate using non-IRA dollars. And I start out there just to make the association a little bit easier, to say that your IRA has a particular name for it. So you have a naming convention for your IRA. And this is true across all IRAs. So if people look at their IRA statements real closely, it technically doesn't say Michael Blank IRA account. It'll actually have the name of a custodian or trust company for benefit of Michael Blank, for example. So that if you buy real estate using your IRA dollars, then you would essentially buy and fill out all the paperwork and complete all the paperwork in the name of that IRA. And that allows you to essentially own the real estate using your IRA. Of course, you're the beneficial owner and controller of those particular dollars. So it's not that different. So when you say, how do you use an IRA to do it? You essentially need to work first with a provider, a custodian provider that allows you to access cash dollars, has a naming convention for that IRA, and has the ability to distribute it in form of cash to make that purchase of real estate. And that can be done, whole outright in a partnership. A little bit tricky if you actually use loans, for example. But we can get into that a little bit later.
Henry, are all custodians the same, or are there different ones out there that you find that provide better customer service or are more accustomed to this type of investment?
Yeah, well, maybe the way to answer that question is let's step back a little bit. So you mentioned earlier that you just found out that, hey, someone that thought they couldn't make a $50,000 investment, turned out they had $500,000 in their IRA or 401k dollars. So if we actually put dollar amounts on that, there's currently, even with the current market environment, close to $30 trillion in retirement accounts, US only. About 12 to 13 trillion is in IRAs, and about 6 to 7 trillion is in 401ks. Now, to get to your question about certain custodians, there's traditional custodians, those ones that only let you stay on that investment spectrum for traditional investments. So those are maybe the big brokerage houses that we know about and the big investment firms. So Merrill Lynch, Vanguard, Charles Schwab, Morgan Stanley, if you work with a financial advisor and such. And then there's a side of the industry, self-directed capable IRA custodians, of which they control roughly about 400 to 500 billion. And I would say within them, people have varying degrees of opinions on how customer friendly they are in terms of letting you do things like real estate or private investments. I just think that most of them are a lot less tech savvy, so you don't do a lot of the interactions through a website like you might at Fidelity or Charles Schwab, and you have to do a lot more with actually sending in pieces of paper and or contacting people. And that's where Rocket Dollar is trying to change that a little bit. So we're trying to apply this sort of tech first approach to this, thinking that most people today, actually, if anything, we sort of freak out, right? No one wants to answer their phone unless you know exactly who's calling you. Like right now, our phone's on silent during this recording are probably going off and no one answers that phone. So my belief is that I want to bring tech into the self-directed IRA space.
Talk about the process of opening an IRA account. So let's go back. I want to buy a piece of real estate, or I want to make an investment in a syndication. The process, like you said, is very similar. But so I got some money in an IRA. What is the process of actually moving that into a self-directed account, such as Rocket Dollar, for example? And then give us an example of how that paper works and actually sending the money. How does that work?
Sure. And so opening the IRA account with us, we have it as an online process. So there are 6 screens, there are 7 clicks, and we have obviously record data on thousands and thousands of instances. It takes our average customer about 3 minutes and 55 seconds to get through that process. So we call that part the opening of the account. Of course, that creates the new self-directed or alternatives investment capable Rocket Dollar IRA. And once that account is established, the second step is that what you're getting to, Michael, is transfer. So you can transfer like-kind investments or like-kind assets. So in this case, it's like-kind assets. So another IRA account at presumably a traditional custodian, you want to move, liquidate those accounts or those investments to cash, and then transfer that cash into the IRA at Rocket Dollars. That's the second step. And the third one is invest. And from an investment standpoint, if you happen to be doing real estate and you have all the paperwork needed necessary to go make that particular real estate investment, instead of filling it out as Michael Blank, supported by, I don't know, XYZ mortgage from ABC Bank, for example, you probably will be filling this paperwork out in the name of the IRA. And in our case, because you said even people that felt they didn't have $50,000 to do the minimum investment all of a sudden find out that $500,000, you'd be surprised to find out that most investors buying real estate using their Rocket Dollar or self-directed type IRAs are doing 100% equity purchases.
And this is probably, you mentioned something earlier, alluded to it about loans. And what is the issue or the complexity with buying something with a loan?
Yeah, so it's funny, if we had a little bit of a tree branch to kind of talk to show how we've moved around, essentially around the same tree trunk and just going off into certain branches in this conversation so far, that I mentioned earlier that you can use your IRA dollars for investments. You just can't go into investments with people that are your direct relatives, a spouse, a son, a daughter, a mother, father, for example. Well, that disqualification of a person that you can't do business with actually includes yourself. So if you use a loan, it's kind of deemed that you are benefiting from getting a loan yourself, using yourself and your creditworthiness to get a loan to support the purchase of real estate using your IRA dollars. So that's why you can't use a traditional mortgage to get credit to then purchase that real estate. You can only do a non-recourse because then the recourse is only back to the property. So that's another reason why you see a lot of people do a very high, if not 100% equity component purchase.
I see. So if you're buying a house, let's say, you would buy that with 100% cash using your IRA. Now, if you're doing a syndication and that syndication uses a recourse loan, is that why people can invest with your IRA in a syndication?
That's exactly correct. And then the other thing is typically in a syndication, you're very passive, you're arm's length. So unless it's, Michael Blank Jr., for example, making that investment in the syndication using Michael Blank Jr.'s IRA account, then most of those people are arm's length to you. They probably function in the capacity of a limited partner, and you and your organization are the ones making the decision and management of the property.
Are there any downsides of owning real estate in your IRA or 401k? And one of the things that I remember is that sometimes you have to pay this UBIT tax. Can you talk about that a little bit?
Yeah, so you just need to make sure that you need to determine if you might end up being subject to UBIT by the particular investment you make. Now, most people who are using self-directed IRA accounts to purchase real estate are actually pretty knowledgeable in terms of asking that, hey, is this going to trigger any UBIT? So you're trying to do ones that are very, very passive, no business income, for example. That's usually the way to go with that. And I think the more relevant, and we talked about this a little bit before the recording, is that a lot of tax advisors will sort of advise that, hey, you don't want to own real estate using your IRA dollars because then you don't get any of the tax benefits of owning that real estate. And again, I don't know if you guys know this, you'd alluded earlier to my financial services background, but I actually also pretty active in real estate. So I have active real estate license that I maintain as well. But I've also been in financial services. So I'm a big person on diversification as well. So I think that people should actually own properties both using tax advantaged accounts and using taxable accounts, and different properties will probably be more suitable for different types of holding capabilities in those accounts.
So yeah, and going off that, Henry, that's really a good point. What do you think are some of the major pros and cons to investing with an IRA versus just cash? Like, what if you had to list off the major ones? What would they be?
Yeah, and this isn't going to be everyone in your audience, but I know that you'll have quite a few because we have those as investors. But there's actually a lot of people that really like the tangible aspect of owning real estate, but they don't need to own real estate as an investment for income purposes. So they actually have no need for the rental income that may come on a monthly, quarterly, or a distribution basis if they're going into a syndication. And they actually like owning it inside of an IRA because then they don't have to worry about paying ordinary income on any income that may be distributed from these properties. It just kind of goes into the IRA. And again, holding investments, whether real estate or let's say traditional stocks, dividend paying stocks we use as the counter example here, is very similar if you think about it at a high level, that if you own XYZ dividend paying stock and they pay a dividend on a quarterly basis, that dividend you can take in the form of cash, and it would just, if it's inside of an IRA, you would just accumulate a cash balance inside of the IRA with its same tax deferral characteristics. Same as owning a rental property that has a monthly rental income stream to you. And if you don't need to use that money, you could actually just let that sit inside of the IRA and grow tax deferred, and no ordinary income taxes or current taxes due. So I think that's one of the pros if you don't need the income. The cons are, of course, are that same counterexample. It's exactly the flip side of that, which is that you have someone that wants and needs to own 2 rental properties and needs the income from those properties on a monthly basis to supplement their current income. And if you own it inside of an IRA, you can't do that unless you're over 59 and a half. So that's a con. So there are limitations to how and when you may be able to use that particular income with the advantages therein. But, I just think that for people, almost every person that owns real estate inside of an IRA typically owns a piece of property in a taxable way outside of it. And then most people that probably own a property in a taxable way, a lot of them actually first got into real estate by being what we call, like, in the industry, accidental landlord, right? It's their old house. They bought a new one and they just decided to keep the old one as investment property.
So how do taxes play into that as well? Like, a lot of our investors take advantage of bonus depreciation. Does that still exist for the IRA?
Yeah, all that stuff would not be applicable if it's owned inside of an IRA. So you don't get the depreciation. You just realize that, hey, look, the house kind of turns into like you have a cost basis, $250,000 on the property, generates monthly income of $1,250, for example, and you can defer the taxes on that particular income and you can accumulate it. You can't receive it unless you're over 59 and a half and it's owned inside of an IRA, but you also don't get any of the depreciation. So really it's just like a straight gain on that cost basis if and when you liquidate that property.
It seems like you need to have a conversation with your CPA. And one of the major advantages of having an IRA 401k is that you have a bunch of cash there. Does it make any sense in some cases to simply liquidate, and pay the penalties and interest to get cash and you use that to invest in real estate? Or is that very, very inefficient?
Yeah, it's a little bit inefficient, but I would actually, sort of be safe in saying that there are people where the situations kind of dictate that makes sense for them too. So we do have people, this is a scenario, and you definitely want to consult your tax professional for this, but we have people that decide to use a portion of their 401k today to purchase a property. And I'll use an example here in Austin, Texas. They'll actually use it to purchase a high-rise condo, a 1-bedroom, 1-bath condo in a new high-rise here in the year 2023. Realizing that, hey, youngest child of 3 is 8 years old today. So in 10 years, they'll be out of the house, they'll be off to college. Maybe I buy this property right now, using IRA dollars. You open a Rocket Dollar IRA, transfer $600,000 of the cash from a old 401k existing IRA, buy that property with the full intent to actually distribute that property and pay the tax penalties 10 years down the road, thinking that the benefits of, or the cost of the distribution and penalties later and having to pay taxes are going to be less than what the appreciation would be 10 years from now on a $600,000 condo, if that makes sense. So they decide to buy today with the full intent that, hey, I'll distribute it. And this happens a lot, by the way, in self-directed IRA investors who do some sort of like private equity or technology startup investment. Let's say that they do an investment that turns out to be a 35x return. At that point, they may say, hey, it's well exceeded my expectations in terms of what I ever thought I was going to get. I want to take out some of this and enjoy my, investment success, pay early distribution penalty and taxes that would normally be owed. And instead of a 35xer, they're left with a 27xer.